Good morning, good evening, good afternoon, trader Steve here at LogicFX Trading, and welcome to our first stock watch. I don't know if that's what it's going to be called, guys. Our stock watch analysis video, and this one's basically going to try and show us the process, and obviously the process is still in development, but give you an idea of what it is I'm talking about when we talk about this or we mention this. And as I say, I'll try and do these maybe daily, maybe 2 or 3 a week. We'll see how it goes. I think down the line it will be daily, but while I'm still trying to get used to it, get through the teething problems, where do you find the information, etc., it's going to be a bit sporadic at the start, but we'll get there eventually, guys. So we're looking at this part. We do this FX analysis on a daily basis, as you know. We'll separate it out from news and reviews, which we'll try and do on a daily basis as well. And then we'll look at the account once a week. And for marketing purposes, I'm going to start doing this at the weekend, doing a weekly analysis of, what's going to go ahead. And as I said earlier, we'll start doing posting some charts to TradingView again. That just gives us talking points to come back to and say, hey, this is what we thought back then. This is what's happened in the meantime. So that'll help with that. Okay, so stock watch. So what we've been doing up until now, or what I've been doing with the account up to now, is that we only really started trading stocks about 6 months ago and really got into it properly at the turn of this year. But what I've been relying on really is, because it was such a massive amount of information to catch up on, because I haven't been trading stocks for a long time. And remember, trading and investing is two different things, guys. But what I was basically doing was going over to LogicFX, going over to eToro and going through the research, the charts and the stats, and trying to find something that, according to all the experts and according to all of this information that's been gathered together by eToro, what's a good buy, what isn't a good buy, what's a hold, etc., etc. So I've been relying on these, and we've kind of done okay. But the problem is, guys, we're getting to the stage where the growth stocks are going to correct. And we've already saw there's been a rotation into a bit more value. And now they're talking about maybe starting to look at European shares, etc. So we've got to be in a position that when a certain trend finishes, we can quickly switch to and find where the value is, or where the good shares are within the new sector or the new exchange, or different types, from growth to valuation. And we need to be able to do that quickly, because when this whole rotation, we talked about the rotation, by the time I got round to starting to look at rotation stocks, they'd all gone up, guys, and we missed it. So I want to get as fit, as it were, by having a deeper understanding of what's going on in the stock market, so that whenever they say, hey, there's going to be a rotation from value into growth, or vice versa, or into Europe, we're in a position to say, hey, these are the European stocks we should be looking at. Here's how we're going to evaluate them. And yeah, there's some good ones. Let's have a look at that one, etc. That's going to take time to get that all together. But obviously, we've got to start with not necessarily the first step, but certainly a step along that path. So what am I looking for at the moment? Well, because I've looked at growth stocks and I've started trying to evaluate the companies according to the financials, which is really what you're supposed to do, rather than just looking at the charts and listening to what everyone else has to say, remembering most of them are just trying to hype a stock because they're already in it. We've got to see through that and do our own analysis, guys. So how do we go about that? Well, how I'm going about it is that I've gone through hundreds and hundreds of stocks that we've got here. We've got to start somewhere. There's good information here. So what I've done is I've gone into into trade markets, and I've gone into here, and I've gone stocks, which is what we're looking at the moment, and then go exchange. And then within the exchanges, I've started with NSYE, guys. Now, some of the stocks that are in here are also in there, but I've started with NSYE. I've done a bit of it in the NASDAQ, started with A, guys. And I've gone, okay, let's have a look at A. What is it? What's the company? And this is familiarization as well. So when we've been doing this for a few years, we'll go, oh yeah, do you remember that company? We had a go at it, or we looked at it before and we didn't like it. CRISPR, I hope they're right with that one. And then I'm just quickly, and I'm going, into research first. This is run a bit so. And it says it's a strong buy. So I'm taking that and I'm having a quick look and I'm going, well, where are we? 133. It's 135 is the low estimate. So, according to what these guys are saying, there's more upside to it. The average price target is 188, which is 41% higher than where it is. And then I'm going over here and I'm going, what's the market cap? 40. What's the price to earnings ratio? 51. Now that's high, guys. But it would still be worth having a look at. Because what you could do is wait for it to correct, get the price to earnings ratio into a zone where we'd be happy, and then we could buy that stock. So we put it on a list. So what I've done then, I'll probably put this PE too high. So in other words, it's a stock that I fancy that we need to do a bit more research on, but the PE is too high, so I've put it into there. All the ones I've put them in moderate buy and some in strong buy. Now if we go over to, oops, take it out of there. If we go over to here, so I've done that, and I've a lot more to do with that, guys. But we're working our way through it, and we'll work our way through the NASDAQ, and we'll work our way through the European bourses and through the London bourses, and we'll get ourselves a group of stocks to start to drill down with, to find the ones that suit what we're looking for, which for me at the moment is value stocks. Although if I do find a growth stock that I don't think is the PE's too ridiculous, then we'll put it into there and we'll say, well, let's see if it comes down into that value, and we'll keep an eye on that. Okay, I'm trying to remember everything because I've been thinking about this for a few weeks, guys. I'm trying to get everything into this little video. So at the moment, that PE is probably too high, but we can also go and look at, the sector that it's in and find out what the average for the sector would be. And if you find that it's lower than the average of the sector, then maybe you can say, okay, well, let's get into it now. But we do have to be careful, because as we look every single day on the price charts, and we go and we look at, let's just take the NASDAQ for an example, guys, and you look at how much it's come up, we do need to be careful, because there is going to be a big correction, guys. And this is the reason why I'm doing this valuation side of things, because not all stocks will fall by the same amount, guys. And if we've at least protected ourselves by getting into stocks that at least have a chance of being a good, solid company, whose price, will drop with the rest, but there's a big chance that it will come back up again, rather than that was a stock that was pushed up with the whole growth thing. In actual fact, there's nothing there, and bang, it goes down by 60, 70, 80%. You don't want to be getting caught out in those, guys. Okay, so that's kind of what I'm doing, and you know me, I'll explain it, and I'll explain it, and I'll explain it, and we'll all get on the same hymn sheet with this, guys. So as part of that, let's take a look at one. Abbvie was one I was looking at. Now, the reason I was looking at Abbvie was I had been in it before, and then when I cleared the decks a while ago, a few weeks ago, I got out of it. I don't want to buy it. We want to get it up. Why is that doing that? Abbvie. Yeah, there we go. I had been in it, guys, and when we cleared the decks the other day, it was sitting around zero. And I just took it off because I was trying to get money out of the market, because I was worried that we were going to get a crash, guys. But I've come back to it because it had been recommended. I had read it in Motley Fool or somewhere like that, which is how I got onto it. Excuse me. I liked what I saw, but I hadn't done any, deep fundamental research. So I thought, well, let's have a look at Abbvie and see if we can justify buying it again at its current price. So the first thing I did is first thing I did was here and looked at the PE. I thought, 38.95, that's high. Because really you should be looking for something under 20. But with today's high prices, you're going, well, you're not getting much under 20. And also, if it's a growth stock, then you're going to get a higher, a higher PE. People are going to pay more for future growth. Now, there's a whole conversation around that, which we'll not have now, but we'll talk about as we go on. So I'm saying, well, it's a bit too high, but let's have a look at it and drill down and see whether that ratio is justified. So you go and you look at revenue and you go, well, 50 billion revenue on a market cap of 100, call it 200. So that's only times 4. That's good. But obviously revenue's one thing and earnings is another. And then you go down and your earnings per share is 2.84. Well, that's good, because an awful lot of shares you look at, they don't have a PE and they don't have any earnings. And yet, their market cap is 4, 5, 6, 10 billion. You're going, well, what are you paying for? So you have to at least make sure the company's making money, folks. Let me just kill that alarm. That's the Dow Jones. It's going up. Oh! We've just, it's 2:30. The market's just open. I would normally be looking at the account, but we'll carry on here with what we're doing. So having looked at that, dividend yield 4.96%. Let's go and have another look in your research here. What are these guys saying? They're saying it's a strong buy. We've already looked at that. It's 112. There's a potential upside to the mid target of 13.98%. Not massive numbers, guys, but it is a big company, and they're turning over a lot of money and they've a reasonably good profit. Okay, so it's still worth looking at. You can go and read the articles, see what these guys say. You can come down here and you say, well, Warren Buffett is added. If Warren Buffett's holding it, it must be a good company, guys. But yet again, it's still about the price. Remember, it can be a good company, but if the price is too high for getting into, we still need to do more. So his holding now is at 2.7 billion. Holding change 20%. So he's added, I think that means he's added 20%. Obviously, other people have reduced, but old Warren here is getting into it. So that's a good sign. So we've done a bit there. To be honest, that's new to me. I didn't notice that before. So, okay, so that's made me a little bit, I'm keen on this. So then the new thing I've signed up for, guys, this is a subscription thing from these guys who are reading money. They're really only getting going. You guys can sign up to it if you want, but really you don't need to, because I'm going to do all the work for you. So they've this thing called 8 pillars, where they look at, their 8 pillars are these. They look into the fundamentals of the company. The one thing I've got from listening to them is that they're looking at long-term investments as opposed to trading, guys. So there is a little bit of a difference between what they're doing and what I'm doing, and possibly what you guys are doing. But that doesn't mean that we can't maybe take 20% or 25% of the stock and stick it into something that's long-term, that we don't have to worry about all the time, and get it away from zero and let it run. So you're looking at a proper valuation for investment. We'll see down the line whether that's viable or not, and whether we want to do that. Because if you're doing all right, jumping out of in and out of things and beating the market that way, then you might want all of your money. But it's something to look at anyway. So these guys are these 8 pillars, and really, according to them, what you should be looking for is companies that have all 8 of these ticked green. Before you start doing your in-depth analysis of the company. But I've started over this side, and I've come over here hoping that they're all green, and then I've come up against this and I've gone, oh, do I stop here or do I do a little bit more? And I thought, well, just for the sake of the video, let's do a bit more and work out. Do you know, the whole thing is we learn from problems. We don't learn from getting it right. We learn from getting it wrong. So if we overlooked this and moved on, well, we're not going to learn anything about the reasons why the price to earnings ratio is 42 rather than below 20, or why the net income hasn't continued to grow for 5 years. You've got it there as minus 1.34 billion, or why the shares outstanding aren't decreasing, which is what they're looking for. which means that, the value of your shares is increasing rather than decreasing because they're not diluting them. And their assets are greater than their liabilities. And I'm going, well, let's drill down and find out, is there a good reason why all of these are X's rather than ticks? And if there is, then maybe the company's still worth buying. Okay. So what I did next was I went over to the income statement and I said to myself, well, okay, why is there a problem with, sorry, what was it we were talking about there? 8 pillars. Why was the problem with the net income and the assets and liabilities? Obviously, this one's a different thing, but it may also be affected by the fact that the income's dropped. What was the PE ratio last year as opposed to this year? Because now it's wrong. So let's go back and we'll have a look at that. We go to the income statement and we come down here and we see net operate. I'm going straight to this, guys, because I've studied this and I know where to look. Net operating interest income, minus 2.28 billion. Last year it was minus 1.51 billion. The year before, minus 1.1 for 1,965 million. That's increasing. And you're going, but at the same time, their operating revenue is increasing. So we've a tick there for profit margin revenue growth, but not income. So there's a problem, but we need to find what is the problem. Is it something that's happened in the meantime that can be explained away? And then we go, oh, next year they're going to be back on target with income. So that's something we need to dig down. So I thought to myself, why is there a $700 million missing there just between there and there? Now, without getting into everything else, that was my big thing. Why is that? And I thought, well, there's something going on. And then the other thing was average basic shares outstanding and average diluted shares outstanding. 1.62, 1.6, 1.5. So it was going down, which would have been okay because they're share buyback. So, you're increasing the value of individual shares of making enough money to buy back shares and increase your value. And then 1.78 or 1.48. So going down. Everything's okay up to there. And then 1.77 billion. So they're raising money for something. They're spending money here. That's up 700 million. Those are up by, what's the difference there? So call it 30. That's up by 300 million shares because that's 1.44 billion. What's going on? I thought, acquisition. They must have bought something. So then I went over to their annual report, to their website, got the annual report for myself, had a dig through it. On page 56, I found this. Financial position, liquidity, capital resources, cash flows from, this is for the year 2020, 2019, minus 37 billion. Financing activities from being 18 billion in the green, they've gone to minus 11 billion. Now there was something going on over there as well. We're just looking at this. So if you add those two up, and then their cash flows 17 billion. You add those two up, you've got 30, 40, 48, $49 billion. And you're going, right, so there's $49 billion disappeared from somewhere. Then you read down here and it goes, operating cash flows in 2020 increased from 2019. We saw that. It says, including the results of Allergen subsequent to May the 8th acquisition date. So on May the 8th, they acquired Allergen, and with 48 million missing there. So I thought, right, we need to find out more about that. Now, there could be that, the whole thing about that is probably in here somewhere, guys, but I didn't fancy searching through 56 pages for it, and there's more, because I'd found this by, I was scrolling and started finding things and was just quickly stopping. So I thought, well, let's go over to Google, our old pal Google, and find out what's going on. And we looked up Allergen, And on Wiki, this is without even getting into any details, and look down here, and it says in June 2019, US pharmaceutical company Abbvie announced that it had reached an agreement to acquire Allergen for $63 billion. Right, so there's where the shares went as well, guys. So you had 63. What was our numbers back over here? Sorry, in here. Let me get rid of that. 63 minus, what did we say here? Oh, I've moved that now. No, I haven't moved it. Where are those figures? Oh, page 56, where we on? Yeah, there we are. So I would say it was 49 billion from 63 leaves a 14 billion outstanding. That's probably, and I don't know this and I need to go and research this, but off the top of my head, that's probably where the 300 million shares went to, guys. So they weren't issuing shares in order to spend the money to give a dividend. Now that's not good. You don't want to see that. They've issued the shares to raise the money to make up the difference here, investing activities and financial activities. Now, if you go back to our 8 billion or 8 pillars here, and we go to the income statement, there's only 700 million difference there. So the rest of the money's been borrowed. The money's been borrowed, and that difference has been interest payments, guys. Interest on the 40 odd million or whatever it was that they had to borrow to buy Allergen. So it's growth, but it's growth by acquisition. They had to pay for the acquisition. It's increased their operating revenue, but it comes through this year as obviously a problem, but they're paying it off. So if you go and you've a stall where you're selling apples and you're making X amount each year, and all of a sudden you decide to buy another stall, well, for a period of time you're going to be paying for it, but your income's increased, or your revenues increased because you now have 2 apple stalls. I hope not. I'm not trying to be. I'm just I hope that's not too basic for you guys, but you understand me. I'm just trying to justify the fact now. So when you come back to this, all of a sudden there's a justification. They haven't lost market share. The competition hasn't come in and forced them to lower their prices, so that the income has dropped. The net income has dropped because they're paying for the acquisition. Shares outstanding has gone up because they're paying for the acquisition. Assets and liabilities I need to dig into a little bit, guys. The liability side is up because they owe money. They borrowed the 11 billion to pay for the acquisition. So those ticks, and that's down because their income's down. That PE is 42 because the income was down for the year. So that pushed the PE up. And those other ticks are there because of the acquisition. So when you go through all of that, you kind of go, do you know what? This might actually be a good company to get involved in. Right. So having gone through all of that, I think it's a half decent buy. At least we're doing something to find out what the numbers are, what the valuation of the company is, why is it valued at that, and is it going to continue to be valued at that? Is it going to continue to be profitable? And I would say yes. So you can do a bit more, you can dig a bit more, but we've dug an awful lot more there than I was 2 or 3 months ago, guys. Because 2 or 3 months ago, I was following whatever these guys were saying. At least now, with a better understanding of why these guys are saying their price target's 128, 129, 124. Why has Warren Buffett bought into the company? Okay, now, that's the type of thing I'm going to be doing. Obviously, we'll maybe go into things a little bit more detail. But we'll find that out, and it'll become a lot quicker for me the more often I do it. Okay, guys, that'll do for the day. I think I'm going to buy Abbvie today. In fact, I'm pretty sure it was up today. We go and look over here. Go to stocks. Go down here. It'll be, there's there. And, oh, that's 4 hours, I was going to say. I think it opened up today and it's come off a little bit. From a technical point of view, guys, normally I wouldn't buy anything there. So that's my only hold back at the minute, because you're kind of in a double top situation there. So if you're really going to be pernickety about it, the way a lot of times I am, you would really want to see this coming back down into this flat and then picking it up a lot cheaper here, guys. And then, you know, the price to earnings ratio will be better as well. But the problem with that is that if you wait for that to happen, it could push on through there and then you'll miss it. So the thing to do is maybe take a little bit, you know, maybe a 1% share there. And if it drops, by another 1% down there. Because I do think it will go long, guys. Okay, that'll do for this. Speak to you all again. Bye for now.